Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy this program, give us a like, share, subscribe. My guest today is Alex Ypsilanti, co-founder and CEO of Quantifeed, a B2B wealth tech. When I spoke with Alex, he emphasized growth is still driving the Quantifeed business. So we spoke about the business model, the evolution in B2B wealth management, how he's working with various types of institutional partners, and of course, this wouldn't be complete without discussing the interplay with AI. Alex Ypsilanti from Quantifeed, welcome to DigFin VOX.
Jame, thank you for having me. Pleasure being here.
So you help co-founded and run Quantifeed, which is a major player in the wealth tech B2B space. Last year, you notched a significant Series C fundraise with a combination of existing and new strategic investors. So things seem to be firing well for Quantifeed. I'd like to use this to get your take on the state of that sort of B2B wealth tech industry. How has it evolved? Where are we right now, and where do you see it headed?
Sure, yeah, good question. We've developed the company over the last 10, 12 years to provide B2B solutions to banks, brokers, insurance companies, asset managers, and the like across three key verticals, which we like to describe as build, distribute, and manage. So we help our clients develop investment strategies more effectively, being able to customize, visualize, and analyze those strategies. That's the build. On the distribute side, we help particularly banks and other wealth managers strengthen their sales channels, namely the advisor or RM-led channel, so providing tools to advisors, helping them around portfolio management, doing, if you like, the heavy lifting around investment decision-making and allowing the RM to focus on the relationship, the client. And then the other channel solution, oftentimes referred to as robo-advice, is what we call customer direct. So essentially powering digital solutions or on mobile app for banks, allowing them to offer wealth management, particularly to the masses, retail and mass affluent investors. And then the last vertical is the manage, which is all the sort of heavy lifting and complex back-end operations, portfolio rebalancing, order and trade management, fee calculation, corporate actions, oftentimes what people think of the boring stuff, but it's actually the stuff that gets the advice implemented and running.
It seems like compared to, say, a B2C robo business, the main difference, the differentiator is really that distribution aspect. How much of your business, your time, your resources have gone into the distribution side, and developing things for RMs to use as opposed to these other capacities? Am I accurate in saying that that's really the main differentiator between you and a B2C, or is there more to it?
Maybe there's a little bit more to it. I mean, the main difference is the business model, of course. We sell to existing wealth management organizations rather than going direct to the consumer. We do sell a consumer-ready solution for banks, brokers, and insurers. But obviously the business model is different. We have devoted a huge amount of effort, particularly in the last 2 to 3 years, on that advisor-led piece, if you like, which is a big differentiator, as you pointed out, versus the B2C. Part of that work was organic, so we built internally, but it was also catalyzed by an acquisition that we made of another fintech out of Europe in late 2022 to coincide with our Series C funding, as you pointed out. So that acquisition brought about marquee clients in Europe, some of which were private banks, others were asset managers, but it also brought with it a very strong team and a very strong set of capabilities that we then morphed into the RM-led or advisor-led solution, as you pointed out.
With these different strands to the business, Alex, how much of your business is a SaaS model where you develop a product and here it is, Mr. or Mrs. Private Wealth Management Institution, and how much of it is they come to you and say, very nice, but we want it colored yellow and available on Mondays through Saturdays, and it has to do this, that, and the other. And then, of course, every other institution would then also want that. How do you manage that balance, and how do you manage the costs?
Yeah, that's a very good question. And I think it sort of hits the nail on the head with respect to our business model. And I think part of the reason why we're a leading provider in Asia and Europe with respect to these solutions, it's about striking the right balance. And dare I say, if the institution all they wanted was the yellow, that would be the easy bit, and the Monday to Friday. It's a, I like to think of it as a SaaS plus solution. So we have all the components on the shelf, all the components are out of the box. What perhaps is the customization bit, if you like, is how we assemble these components, these bricks, if you like, how we connect them to the institution's existing systems to then create a unique and compelling proposition for that specific bank. And we've obviously done a huge amount of work to develop that platform of capability, those components, but we've also cut our teeth in the last 8 to 10 years, really honing that assembly process, that delivery process, in terms of understanding what big banks want. And as you say, it's always very unique and very different, and being able to assemble efficiently and quickly to create these unique propositions.
Yeah.
You know, we have been working with tier banks, as you know, both in Europe as well as Asia. And the only way to service these institutions is with something unique and compelling.
How do you manage those relationships? For a lot of startups, getting the bank, maybe this is harking back to your earlier days, Alex, but getting those from POC level, trying to keep your head above water, dealing with these giant institutions. Has that changed much for you? Are you still sort of having to kind of negotiate and navigate these large institutions and make sure that you're seen as a value add rather than just another plug-in vendor, or are you at a point now where you have a different kind of relationship with these institutions?
We've certainly gone past that sort of critical point. We've got a very strong track record and credibility. With a sort of juggernaut, if you like, certainly in Asia with respect to these solutions. So, we'll try to avoid POCs or prototyping, if you like, and go straight to a real sort of product and project. But as you know, large institutions are very complex. The larger the institution, the more complex it is in terms of priorities, people, economics, and so on. So yeah, sales cycles in our industry can be quite long and complex to navigate, but we've now built the expertise, the experience, if you like, to try and accelerate them as much as possible, and really offer the sort of right solution to the counterparty, to the client, at the right time, and be able to navigate that.
Is that also translating into profitability? Where are you in terms of the business, its ability to create margins and talk a little bit about the balance sheet side of operating this kind of business?
So yeah, we are profitable. We've got revenue growth of 30 to 40% per annum over the last few years, obviously growing very steadily, as I just mentioned, and will continue to do so. So yeah, very pleased from that perspective. Despite the sort of post-COVID, bit of economic downturn, but there was certainly a couple of years of what we internally called the fintech winter. No doubt your business saw this as well in terms of the counterparties that you speak to, but it certainly feels that we've come out of this stronger, and we're certainly witnessing a return from a client perspective in terms of projects. So, projects are being accelerated, budgets increased, and so on.
What's the driver now? I mean, COVID's sort of an obvious digitalization 101 kind of story, but that's now 5 years in the past plus, I guess. Um, what are the drivers now? Is it new geographies? Is it retail versus institutional versus high net worth? Is it new features? Where's the excitement right now?
Certainly, the two key drivers for us is advisor-led solutions, particularly when it comes to consumer banking or retail banking segments. I think all the banks we speak to are very keen to ensure that their RMs are being as productive as possible and the clients served or serviced as well as possible. And really to do that effectively for that client segment where you've got RMs that aren't necessarily investment experts, and each RM covers anywhere between 100 to 300 clients. The only way to do this effectively is through the use of technology. That doesn't mean that you're removing the RM, you're actually empowering the RM with more capability, including Gen AI and sort of a lot of the sort of more modern technology. So that for us is extremely exciting, and we're getting a lot of traction in this space. And of course, the other area that continues to grow is the D2C, direct to customer. So what people oftentimes call robo-advice. And that also has its place with certain client segments who are more self-directed, prefer not to speak to RMs, maybe don't have the time, and are actually first-time investors in the first place, so don't necessarily need too much help from an RM.
Let's break those two points down. One is the RM and the tech that goes into that, and then I want to ask you about the direct consumer side. So on the RMs and the tech, we've seen an explosion in the AI world. That's not going to be news to you or anybody else. How do you interact or interrelate with banks' internal AI work, whether it's machine learning and predictive analytics or it's on the Gen AI side? At what point do they want to do things themselves, or what point do they want you to do it? Or how do you interact with, say, other types of fintechs or bespoke AI firms that are also, whether it's doing, back end onboarding, fraud detection, or if it's, other types of pattern analysis around asset allocation or whatever is the use case. Just what's that interplay like, and where do you see it going?
There's definitely a need for a platform of solutions, whether that is the bank developing some of those solutions internally. And all banks have the desire and capability to develop some of this internally, whether it's solutions or actually data that they in-house. But from a vendor perspective, there's no single vendor that has all the bits and pieces. So, despite the breadth of our solutions, we've always been very open-minded to working with partner firms to provide a more holistic, more complete, more comprehensive solution to the bank. And banks from their side don't want to contract with multiple different vendors and bring them all together. They would rather sign up a sort of ready-made platform, if you like, where vendors have come together in partnership to provide this. So in that context, we've been doing quite a lot of work across the board, including in Gen AI solutions. The area that is particularly interesting for us is what we call this middle layer. So we kind of sit almost as a connector layer between the bank's internal data sets. And as you can probably imagine, these are disparate data sets, some structured, some unstructured, sitting in very different places. We bring all of this together on the one hand, and on the other hand, connect to relevant sort of industry standard or off the shelf large language models to create a prompt-based solution for RMs and other professionals within the bank or even the asset manager to make sense of all of this data in a consumer-friendly manner.
Yeah, it almost sounds like you're doing like the old data warehouse or data lake stuff that big IT vendors were pushing a decade ago.
We're not a data lake per se, but we would benefit or take advantage of connectivity to data lakes, bring in our own data sets, because if our clients already use Q Engine, our platform, then certainly some of the data sits on our databases, if you like. And then, as I said, we bring the LLM on the other side to make sense of that data.
Who's responsible for the way the LLM outputs, and how much of that needs human editing or guidance? How much of that can go straight to a customer?
I think maybe it's a little bit early to put it straight into the customer. I think these days when we're still looking at this, and there's still a lot of work that we're doing together with select clients. Um, there's there's professionals who look at the output, RMs, for example, or private bankers, and it's that sort of adult supervision, if you like, that is needed at the moment. But I don't think we're far away from rolling these out to customers. There is definitely a period of testing and fine tuning so that you sort of get the right level of responses from the LLM.
Where do you see as these machines become more prevalent, whether it's still in the behind the scenes or if it's put in front of customers, where will be the areas of greatest advantage using LLMs, and what areas do you think will they be very slow to have an impact on?
I think the greatest areas is getting more insight on what the client should be looking at, what the client should be doing from an investment perspective, understanding what their portfolio needs are and how are they likely to respond to a particular recommendation, and making sure that that recommendation is as personalized as possible. So I think with all the data that banks have collected about their clients, that there's a great opportunity to leverage LLMs to help advisors and RMs identify what is the best way to engage a client. What is the recommendation I should be making to this client that they will likely respond to and will improve their investment outcomes? That is one area. The other area is providing clients a better understanding of their portfolio, the markets, the house view, and again, what they should be doing to improve this in a way that is much easier for them to consume. Nobody wants to have to review reams of fund fact sheets or read CIO reports. You want something that's easy for mass affluent and retail investors to consume, that sort of brings it all together.
And what areas do you think will AI, particularly LLMs, not be ready for showtime or just won't be relevant?
I don't think they're necessarily relevant in making investment decisions. I think folks that sit within a bank's CIO, a discretionary portfolio management team, folks that look at the market day in, day out, are still best placed to make the right investment calls in terms of what is that house view, what are the right portfolios to recommend to clients.
Switching gears, going back to the consumer direct side of your business, Alex, we've seen in the past few years the B2C players like Endowa, Stashaway, Syfe amass considerable size and growing sophistication. Now, you're not exactly in the same lane as these companies, but with your direct business, are you finding that you are competing more, or are there other ways that you interact with them? And what does that feel like?
Uh, the, the, We certainly interact with some of them. Some of them, in fact, are prospects from a client perspective. We don't see them as competitors. In many ways, these new entrants, and they're not that new anymore, as you pointed out, and I have huge respect for what they've done and what they've achieved. In many ways, they are competitors to the traditional incumbents, the big banks, if you like, in their respective regions. To us, they're both distributors of wealth management solutions that we can help grow through our technology. Granted, many of the players you mentioned have developed their own technology in-house, but we certainly look at what they've done as inspiration to understand where they're driving the wealth management experience and solutions from a direct to customer perspective.
Yeah. And because, they live and die by their ability to deliver value in that space, would you say that they've got an edge versus what you could deliver in that direct to customer technology?
I wouldn't say they necessarily have an edge from a technology perspective. I mean, their biggest challenge, if you like, and opportunity is that they own the end customer. So from that perspective, owning the end customer means that you can truly understand what the end customer's needs are, and you can evolve the solution in a much quicker, more agile way to maximize product market fit versus perhaps the speed with which a bank, a larger player, could move.
Yeah. And then tying these two themes together, we were talking about the data that you have access to. In some respects, it sounds like a great model. I mean, the banks are the ones that are buying, it's their money that goes into maintaining the data, and you just get to sort of play on top of that. But how much, they're not your customers though. So uh, are there frictions in being able to deliver those insights or those personalization services when you're using somebody else's customer data? How what kind of guardrails do you have to deal with? How easily can you access or treat that data?
There's certainly guardrails from a technology perspective, and of course, we don't hold personal PII data, or if we do, we're very careful how it's managed, and we ensure that the banks we work with, we go through third-party risk assessment surveys and the like. It is, it's become part and parcel of our business and the process of being onboarded or procured, if you like, onto a bank. So yes, while it is a challenge, we've navigated it quite well.
We're seeing more fintechs coming into areas around either alternative investments, so like a platform like iCapital or Moonfair S64, uh, and then at the same time, we're also seeing digital asset tokenization type platforms trying to make their way into this world. What are your customers saying about both of these? And would Quantifeed be also competing for some of that business, or is it really separate from what you do?
It's not separate from what we do. In fact, many of the banks we work with are indeed asking for solutions that involve alternatives. And broadly speaking, digital assets are classified as alternatives. By virtue of us working with a lot of distributors who focus on retail and mass affluent, that perhaps has been a little bit slower than high net worth or private banking type segments. We don't compete with the iCapitals or Moonfairs. In fact, there's opportunities to partner with them. We have in fact been in discussions with some of these players to bring the two platforms together and provide a much more holistic wealth management solution that isn't just about funds, ETFs, stocks, bonds, equities, but also now can involve alternatives, very much in response to what our clients and their clients are asking for.
Alex, I appreciate your time with me today. We're coming to the end of our conversation. So I'd like to end on kind of the future for the business. You've said you're profitable. You've been very successful at fundraising over the past few years. you've hit a certain critical mass in your segment. What's next for the business? Are there going to be liquidity events or exit strategies? Where do you see the business going?
Yeah, good question. And certainly as a management team, we're open-minded, and part of our job is to create as many options for our shareholders as possible. As I mentioned, we made an acquisition a couple of years ago out of the UK, and we learned a lot from that, and we definitely saw a lot of benefits that it brought into our business, both from a financial, a revenue perspective, clients, team, and product. So we certainly quite open-minded and strategically looking at other opportunities like that. Ultimately, it's all about growth for us. There is so much more we can be doing in the digital wealth space, not just in the markets we're in, but obviously other markets, particularly in Europe, which we've been growing since that acquisition. Asia obviously still remains the area of growth in the world, and dare I say, there's opportunities to do more in obviously other markets like the Middle East and even the US. Part of that sort of roadmap, if you like, of how we achieve it is through partnerships, and I alluded to that earlier in terms of, no single vendor has a full solution. In fact, for many years, Quantifeed has had very successful partnerships with product manufacturers, investment product manufacturers, also known as asset managers, the likes of HSBC, Fidelity, Franklin Templeton, all of which are actually also shareholders in our business. So we want to leverage partnerships such as those to grow the business, both from a product perspective, so enhancing the product offering, making it more complete and comprehensive, but also in terms of geographic footprint. So going together into clients and into new markets.
And then what will be the big challenge for 2025, beyond just the fact that we got some fairly rocky markets and geopolitical tensions, but in the wealth space, as a fintech, growth is still your sine qua non, but what do you have to look out for?
Well, we've been very fortunate to close some very large projects. So obviously being in a position to manage this while at the same time continuing to innovate and create more interesting features, kind of continue to build the product roadmap is always a challenge and always an opportunity to differentiate.
Alex Ypsilanti from Quantifeed, thank you so much for joining me on DigFin VOX.
Jame, it was a pleasure. Thank you very much.